Good afternoon, I'm Steve Spencer with SMB Capital, and today's short video is on the topic of making predictions. The idea of these Wall Street economists making these forecasts seem to get a lot of play lately in the Twitter sphere, financial Twitter, blogs, and it got me thinking, why not take a look at what short-term traders do and why quite often they are able to, quote unquote, make predictions about price action, what's going to come up in the near future, versus what some economists or analysts are doing at these larger banks, and quite often are the butt of jokes for being nowhere in the neighborhood of being accurate. And so let's take a look. So as short-term traders, part of our job every day is to look at different stocks and come up with a thesis as to whether or not we believe they're going to go up or down for that day, or maybe even over the next few days if we're swing trading. And so in order to do that, there's several different things that we do. When something has fresh news or a catalyst, we look and we observe what market participants are doing when that news comes out. Do they first buy? Do they first sell? And we're looking at the trading action outside of market hours, which most people are unaware that this even occurs. And that starts to help us formulate an idea, is this stock going to be strong? Is this stock going to be weak? We're able to identify key levels, and if a stock is below a key level, we know that most likely the sellers are in control, and if a stock is above a key level, we know the buyers are in control. So we're thinking about, when these catalysts come out, how will other market participants react? And we've been doing this for a while, and we've seen the same catalysts over and over and over again, and we can reference back to how different market participants will react. Now, one of the key advantages we have here is we're constantly reevaluating market behavior based on certain types of catalysts, whereas when we contrast that with longer term predictions from somebody at a large bank, they may be using information that made sense in 2011, and they haven't really refined how does market behavior react in 2014. And so that's one of the distinct differences. Another thing that we're looking at as short-term traders is once we come up with our thesis and we identify key levels, we then also will look what is known as the tape. We're actually looking at the buying and selling that's going on at particular prices and noticing if large buyers are coming in and large sellers. And we put all those things together, when we look at the catalyst, when we look at the key levels, when we look at what's going on in the tape, that really we can make an informed prediction then. And what we'll do is we'll put money where our mouth is based on what we think is going to happen. And so, for example, I'll take something from today. Red Hat reported earnings. They reported very good earnings. And what I'll do is when those numbers come out, I'll look at the numbers. I'll see where they are in reference to what was expected. What are they guiding going forward? Then I'll look at all of the different analyst reports who are looking at the stock. Are they raising targets, lowering targets? Are they bullish, bearish? Because the reason those comments from all those analysts are important is who are the bigger analysts that might have more clients, that might put in more buy orders or sell orders. And so I'll factor that in. I'll factor in the initial price action. And what we're looking at right now is how did Red Hat react when the numbers came out? Well, it was very strong. You can see that initial drive. And we can see once it had that initial drive, it basically stayed above $57 a share in the after hours. And never got above, I'm sorry, 67. Never got above 70. When we came in the next morning, one of the key tenets of short-term price action is where is that stock trading in relation to what happened in the after hours. And what we can see is it was still above the after-hour support when we came in. And so what we did was when we discussed it in the morning meeting, you can see I just did a little clip there. This was the second in-play stock we talked about. We had 67 as a key support level to watch. We had 70 as a key resistance level, our top resistance. Another reason why 70 is a key resistance is it is a whole number divisible by 10. Believe it or not, many large traders and many institutions, when they buy and sell shares, they do it at whole numbers. And in particular, they're interested in whole numbers that are divisible by 10. There's nothing particularly rational about that. The herd behavior, there's a lot of orders there. And what we can see is when the market actually opened, again, this little blurb you see here is something we put together at 8 o'clock this morning. The market opened, the stock sold off. Where did it stop? It stopped at $67 a share. And where did it run up to? It ran up to 70. And so this particular stock that we're looking at today, we were able to accurately predict the important prices. And how that's helpful is it gives us an idea of where we want to look to get long, where we want to look to get short, and then also where we want to look for a trend trade if it breaks outside of those two key levels. And so that just gives you an example. And let's compare and contrast this to what some people try to do at large banks. They're making calls over very large time frames. They're saying, hey, I think the S&P at the end of 2015 is going to do this, or 2016 or 2017. One of the things that we learned in law school was there are things called intervening causes, intervening events. So, for example, I'm driving my car down the street and there's wet conditions, it's raining out, and I have a certain amount of skill and I'm driving that car. I know that if I drive in the rain at 45 miles per hour based on my skill level, I'm most likely going to not have an accident. But what if all of a sudden a deer jumps across the road and then I slam on the brakes and I swerve a little bit, and then there's another car that happens to just come out of nowhere, and boom, there's an accident, and there's, accident because certain things happened that weren't anticipated. It's unlikely, 1 in 1,000 chance a deer jumps across the road. So these economists are making these forecasts at banks. They don't know that oil is going to drop 50% over a 1-month period or 2-month period, or however long oil is going to drop. They don't know that Putin is going to step into the Ukraine and these other things are going to happen. So the idea of coming up with forecasts so far in the future when you don't know any of these intervening causes, of course, like, who's going to get these things right? And so that's one of the big differences right there. Another thing is they believe correlations are a constant. When I started trading back in the mid-1990s, there were certain things, maybe there was a correlation when inflation started to tick up, you could get long gold because gold would go up. And maybe that correlation actually disappeared or reversed in the last 20 years. And so they're operating under the assumption that these rules that were in place for a certain period of time, and there's tons of them, that these rules are a constant. And that's not the case at all. Some of them just disappear, some of them reverse, and you need to be constantly looking at these things and re-examining your assumptions. And that necessarily is not what's going on. They're not paid for performance. So as traders, we're paid, we have to make money in trades in order to get paid, in order to live. That's a really strong incentive to get things right. And then finally, people at big banks, they're not trading their own money. And that's another strong incentive to really refine your predictions, pay attention, adapt, change them as much as possible. And when you put all these things together, large time frames, no skin in the game, correlations that are changing, and them not being trained to kind of re-examine their assumptions, they're going to get things wrong most of the time. Why do our things work as short-term traders? Well, they're empirical. What does that mean? It means we're actually looking at things right now the same way a scientist would make observations, look in the microscope, and I'm looking, good news came out. Did the stock go up? Did it hold higher? I'm making empirical judgments based on observations. So that's going to have a much higher likelihood of having some efficacy. Number two, lower time frame, much more likely in a shorter time period to get things right. And then finally, we understand what different types of catalysts, how the market, different participants are going to react. And we're constantly reevaluating those things every day, every week, and every month. And by doing those three things, it's much more likely that there's going to be a higher level of success in our predictions. And so that's the trading lesson for today. That's the explanation why short-term traders actually can get things right 50% or even higher versus maybe some longer-term banks who might get things right 10 or 20% of the time. That's the main difference right there. Hopefully you learned something, and hopefully you can use this in your own trading. Thanks for joining us.